So we're going to work this exercise. The following selected accounts from Orlando Corporation's general ledger are for the year ended December 31st, 2027. What do we need to do? Make a multi-step income statement. We didn't get to that in the PowerPoint presentation on Thursday of last week, but that was coming if we would have kept going through the PowerPoint. You need to know how to make multiple step income statement, the format of it for Chapter 5. That's something you're going to be tested on. So make the multiple step income statement. So this question tests your comprehension of that. So the multi-step income statement has a sales section. So in good form, we would put name of company, name of statement, and then for the year ended, in this case, it's for a period of time, it's for a year. If we were reporting revenues and expenses over the most recent month, then we would say for the month ended or whatever, but for the year ended. So that's the heading of the financial statement, the income statement. And then as far as the body of the statement, single step income statement, we just list all the revenues, add them up, get a total. List all the expenses, add them up, get a total. Subtract the total expenses from the total revenues, that's net income. But GAAP doesn't allow companies to use single-step format. They have to use multi-step format. We're going to get the same net income number. It's just the way we classify things. So multi-step income statement, of which this is an example, has a sales section. Now, if the company just has sales revenue, like in this example, if you look at the list of accounts from the general ledger and their balances, I see two different revenues. Unearned sales revenue is not a revenue, right? It's a liability. That's not a revenue. There's only two revenues in this list, sales revenue and rent revenue. I don't see any sales returns and allowances. I don't see any sales discounts. If the company had sales returns and allowances and or sales discounts, then here's how the sales section of the multi-step income statement would be prepared. Under sales, you would have sales revenue, and then whatever its number is. Then you would say less whatever the balance in the sales returns and allowances account. Then less whatever the balance in sales discounts account. Sales returns and allowances and sales discounts are contra accounts to sales revenue. They reduce gross sales revenue. So this is gross sales revenue. Subtract the balance in sales returns and allowances and sales discounts, and you'll get what's called net sales revenue. You need to know that formula for the exam. Net sales revenue equals sales revenue, gross sales revenue, minus sales returns and allowances minus sales discounts. I don't know why they put this right here behind the professor in the classrooms whenever the professor's standing right in front of it. That was a poor decision, but.
What does that say? Net sales revenue?
Net sales revenue, yeah. Sales revenue minus sales returns and allowances minus sales discounts equals net sales revenue. That's the general format of multi-step income statement sales section. Now in this problem, there's no sales returns and allowances account, and there's no sales discounts account. There's just sales revenue. So in this problem, gross sales revenue is net sales revenue. Usually when you see sales revenue, that's gross. Then you got to subtract the sales returns and allowances to get the net. But if you don't see sales returns and allowances, sales discounts, then the gross and the net are the same thing. Does that make sense? So in this problem, we only have sales revenue. So if you only have sales revenue, then you don't have to make a section called sale. Like you don't have a separate heading called sales. You just say sales revenue here. But if you have sales returns and allowances and sales discount, you need to have a heading sales and then look. So sales revenue, 2589.500. Now you might say, why don't I put rent revenue in there as well? That's a revenue. And on a single step income statement, the rent revenue would be right there because single step, you just list all the revenues. But on a multi-step, you don't put the rent revenue right by the sales revenue because the rent revenue is not revenue you're generating from your operating activities. Your sales revenue is revenue you're generating from your reason you do business, your operating activities. But rent revenue, unless your business is you're a landlord, rent revenue is not revenue that you're generating from your operating activities. You just happen to be a landlord and you're generating some revenue from doing that, but that's not the reason you exist as a business. So any non-operating revenues have to go down lower somewhere else on the multi-step income statement. Does that make sense? Like I'm sure Coca-Cola has some rent revenue. I'm sure they lease something to someone that they own and let the people live there or whatever, or utilize the space. But that revenue isn't revenue from selling Coke. So their sales revenue is revenue from selling Coke and related products. That's their operating. So you see, non-operating revenues and expenses can't show up with the other operating revenues and expenses. They go down. So rent revenue would not be the next thing. The next thing is cost of goods sold expense. We always match sales revenue or net sales revenue if we have sales returns and allowances and sales discounts. Net sales revenue to cost of goods sold expense. Cost of goods sold expense is, it will be here, $1,172,000. Sales revenue minus COGS equals, it's a subtotal on the multi-step income statement. It's called gross profit. You need to know that formula. Gross profit equals sales revenue minus COGS, or net sales revenue minus COGS, technically. In this case, net and gross are the same. On a single step income statement, would you see the line item gross profit? No. Single step, you would just have all the revenues listed. Sales revenue, rent revenue, get a total. And then underneath that total, list all the expenses. Cost of goods sold expense and all the expenses, get a total. Subtract total expenses from total revenues to get, that's single step. You don't classify things, but on multi-step, you classify. Gross profit. Generally on financial statements, in a column of financial numbers, you put the units on the first number, but you don't put the units elsewhere. You don't keep putting dollar signs. So gross profit is $1,417,500. The reason we put this particular expense right underneath sales revenue is because this particular expense most directly caused that revenue. If we're selling goods and getting this much from our customers from selling those goods, we couldn't have sold those goods unless we first bought them from our suppliers in the first place. We're a retailer. in this chapter, merchandising company, not a manufacturer. We don't make the goods ourselves. We're a retailer. So this is the cost to us of buying those goods that we ended up selling for that. So unless we incurred this cost to buy them, we wouldn't have gotten that revenue from selling them. So because we incurred this cost, that led to this revenue. That's one-to-one, like direct causal relationship. So according to the matching principle within GAAP, anytime we can identify for a given expense the revenue that expense directly caused, then we should list that revenue and that expense together on the income statement. And the only example of that is on the income statement. Cost of goods sold expense directly causes sales revenue. So do that. Underneath gross profit, we're going to list out all of the other operating expenses. So we're going to have a heading called operating expenses. Then we're going to indent to the right a little bit and list each of the other operating expenses. So just looking in this left column, advertising is an operating expense. Depreciation is an operating expense. Freight out is shipping expense, us paying. That's us paying to ship things to other people. If it said freight in, that's us paying for things to be shipped to us, but it's shipping. Freight out is shipping expense. Insurance expense is an operating expense. Interest expense is not an operating expense. That's not an expense that we incur from normal business. Borrowing money and paying interest on that interest expense. Because our business isn't borrowing money, our business is selling goods. And these other expenses are directly related to that. So that's why they're operating expenses. Interest expense is expense related to borrowing money in the past, not related to us selling goods. Of course, you might say, well, we had to borrow money so that we could have money to buy the goods in the first place from our suppliers so that we could then sell them. So in that sense, it's not operating. Interest expense is not operating. Right? Prepaid expenses are not an expense. It says prepaid expenses, but that means that's a really funny terminology. Those are prepaid assets. Those are prepaid rent, prepaid. The sum of all the prepaid assets equals the prepaid expenses that they're listing here. So a prepaid rent, prepaid insurance, prepaid advertising. So prepaid expenses is not an expense, it's an asset. Salaries and wages expense is an operating expense. That's the biggest one for most companies, other than cost of goods sold. So you usually list them in descending order in terms of how big they are. So salaries and wages expense will be the first one. All these things that I'm saying have been covered in the PowerPoint. If you look carefully. Multi-step income statement. What's an operating? What's not an operating? That stuff is talked about. 705. Usually we try to keep this there. That. What's another operating expense? The next biggest one would be the depreciation. That's the next biggest one in terms of dollar amount. And then advertising, $55,000. And then insurance is 23. Freight out was 25, so that's a little bit bigger. So we'll do freight out and then insurance. And if you look in the list of expenses, so advertising, depreciation, freight out, insurance, interest, salaries and wages. Those are all the expenses. And of those, all of them are operating except for interest. So we're done with the operating expenses. We get a subtotal of these 5 numbers. And you get 933,000. But we put that subtotal over here because we're going to subtract that from the gross profit, which is right here. Gross profit minus the operating expenses. This is the total. Gross profit minus the total operating expenses is called income from operations. This is our net income from our operating activities, from our operations. Not our overall net income. There may be some other revenues or some other expenses we haven't gotten to yet. But from our operating activities, this is our income. And this is often what investors really care about. Not what's their net income, because their net income includes some one-off things that don't happen all the time, that aren't really big things, some random revenues and expenses here and there, but not from their operations. What's their income from their operations? That's the line item that smart investors care about. Does that make sense? Because in a given year, net income could be vastly different than income from operations, because maybe net income is really high because there's this random revenue. They sold some long-term asset for way more than the book value, and that extra gain is listed as a revenue. We're going to see that here coming up in the other revenues section of the income statement, the non-operating section. And that makes net income really high, but you can't expect that revenue to happen next year. It's not going to happen every year. So really the persistent revenues and expenses are the ones from the operations. So income from operations is a better measure of how the company really did this year than net income. There's income from operations. And then after income from operations, we list all the non-operating revenues and expenses. First, the revenues. We put those in a section called Other Revenues and Gains. So for example, that rent revenue, that was $24,000 will be here. And that interest revenue, I think we had an interest revenue as well, did we? Yeah, interest revenue of $30,000. So we need to list those in descending order. So we'll put this down here. So we must have lended some people some money this period and charged them interest. We get interest revenue. But that's not our normal operations, unless you're a bank. If you're a bank, then interest revenue is your operating revenue. That's how you make money, right? But if you're not a bank, you're not in the business of lending people money. That's not what makes you money. That's not your operating. So interest revenue is 30. Rent revenue is 24. So total, we won't have a subtotal here that says total other revenues and gains. We'll just put the net of these two numbers right here. Like that. So those are the non-operating revenues. You might wonder, what's an example of a gain? A gain is when we sell a long-term asset, property, plant, or equipment, for more than its book value at the time of sale. That generates a gain, and that gain is put in this section of the income statement, the other revenues and gain section. If we sell a long-term asset for less than its book value, then that generates a loss, and that loss goes in the next section. We're about to put the other expenses and losses section. And the only other expense or loss here, the only non-operating expense or loss, Well, if there was a loss, it would say loss on sale of whatever. If there was a gain, it would say gain on sale. But I don't see any gains or losses. But it does have the interest expense, which is a non-operating expense. That's an other expense. $62,000. Except we're going to subtract it. We're going to put it over here in parentheses to show that it's deducted. Like that. And then our final bottom line number, net income, which would be our income from operations, add any of the other revenues or gains, subtract any of the other expenses or losses. So 476,500. And we double underline that. And we put the dollar sign on that number. What's the operating section of this income statement? All of this. What's the non-operating section of this income statement? All of this. And that's it. That's multi-step income statement. Notice in this list of accounts, any account that's not a revenue or an expense or a gain or a loss is not on the income statement. The only accounts that go on the income statement are revenues, expenses, gains, and losses. They just get put in different category depending on if they're operating or non-operating. Accounts receivable, that's an asset, not on the income statement. Accumulated depreciation, that's a contra asset. That's on the balance sheet, not on the income statement. Common stock, it's stockholders' equity, it's on the balance sheet. Dividends, it's not on the balance sheet, it's not on the income statement, it's on the statement of retained earnings. Equipment, it's on the balance sheet, it's an asset. Inventory is an asset on the balance sheet, current asset. Prepaids, even though it says prepaid expenses, those are the assets. Prepaid rent. That $31,000 is the sum of the balance in prepaid rent, prepaid insurance, and prepaid advertising at this moment in time. That's what that $31,000 is. Not on the income statement because it's not an expense or a revenue. Retained earnings is on the balance sheet, and then unearned sales revenue is a liability. It's on the balance sheet, right? So you could get thrown off with this question by not knowing where to classify things. But you need to know where to classify things. One of my students, are you the one that made a list? Or no, it wasn't you. It was Nick, she's not here. One of you all has made a list of all the accounts that you've learned thus far and classified them based on the dealer acronym, either DEALORR. Was it you? Wasn't you? That's a good idea to do that because if you misclassified things, and we're just going to get more and more stuff, more accounts you're going to learn as we go through the semester, then you're in trouble. Like if you would have subtracted prepaid expenses right here in the operating expenses, $31,000, that's an error. Prepaid expenses is an asset because of the word prepaid. Just like unearned sales revenue is not a revenue, it's a liability because of the word unearned. And that's why I wanted to do this problem, so that you guys know those things. Let's work on problem 5.1. Oh, there's one other thing I want to do in this problem, even though it doesn't ask us to do it. I want to compute the gross profit rate. It has us do that in the next exercise, 5.11, but not in this one. But let's show you how to compute the gross profit rate because that's tested on the exam. And it was told you how to do that in the PowerPoints. The gross profit rate or ratio, sometimes it's called the gross profit ratio. There's a formula for it. It's just gross profit divided by net sales revenue. Again, net sales revenue is equal to sales revenue minus the balance in sales returns and allowances minus the balance in sales discounts. In this problem, we didn't have any sales returns and allowances and sales discounts. So net sales revenue is gross sales revenue. So in this problem, the gross profit rate is gross profit, which is $1,417,500, divided by sales revenue. That is the net sales revenue, $2,589,500. And if we multiply the gross profit rate by 100, we can convert it to a percentage. But let's not multiply it by 100 yet. Let's just do the rate. So 1,417,500 divided by 2,589,500 is this number, 0.5474. So it's not exactly equal. I'm going to round it to the nearest 4 decimal places. So when you do that, you should put this symbol, so let's just say approximately equal to, if you're going to be doing rounding, 0.5474. It's not exactly equal to 0.5474. It's exactly equal to that. But 0.5474 if we round to 4, or if you want to express it in a percentage terms, 54.74% multiplied by 100. What does this represent? For any ratio, the interpretation is for every 1 unit of the denominator, the ratio tells you how many units of the numerator we have. So in this case, the units of both numerator and denominator are dollars, right? So for every dollar of sales revenue, net sales revenue, that we're able to sell, every dollar of net sales revenue of our product we sell, 0.5474 of that dollar, 54.74% of that dollar, or about 50 cents, about half of the dollar, 54 cents, we are able to keep in our pocket after paying the cost of goods sold expense. And what do we get to do with that other 54 cents? We can use it to satisfy all the other operating and non-operating expenses. Does that make sense? That's the definition of gross profit and the interpretation. Every dollar of sales revenue, every dollar of net sales revenue, we generate 54.74 cents of gross profit after subtracting the cost of goods sold expense, right? That's what gross profit is. It's net sales revenue minus COGS. So after subtracting COGS, we're left with this. Here's net sales revenue. Subtract COGS, you're left with this. So for every dollar of this, we're left with about 54% of this as gross profit. We've already subtracted cost of goods sold expense, and we can cover our operating expenses. Now, if it asks for if another related metric is called return on sales. Return on sales. And that is the bottom line number, net income, which will always be smaller than gross profit because we take gross profit and subtract some other expenses to get net income. Net income divided by net sales revenue. This is a metric that a lot of investors like to use, although I don't think it's as indicative of the company's core underlying performance. I think the gross profit ratio is a better measure of their core performance than return on sales. So return on sales is this formula. Notice it's the same formula as this, same denominator, just different numerator. The numerator of this formula, net income, is always smaller than the numerator of this formula. So the return on sales always has to be smaller than the gross profit rate, always. Does that make sense? You'll never see a company with a return on sales of 54%. It'll be some small number. A gross profit rate might be 54%, but then we got to subtract all the other expenses to get this. Hopefully all that makes sense. In this problem, the return on sales would be this net income number of 476,500 divided by our net sales of 2.589 million. And then rounding, approximately you get %18.4%, round to the 4 decimal. Right. Still not a bad return on sales. For every dollar of sales they generate, net sales, they get to keep 18 cents in their pocket after subtracting all expenses. That's the net income. Let's move on to the last one we're going to do today, problem 5.1. If anybody has questions as we're going through this, then definitely let me know so we can help answer them. This next one gets at the heart of this chapter in terms of what journal entries do we make from the buyer's perspective, from the seller's perspective, when inventory is purchased and sold. And the company is using a perpetual inventory system, not a periodic inventory system. That's the appendix. You're not responsible for that. That's what this question is testing. Knowledge of the journal entries that buyer and seller make for inventory transactions. So Powell's Warehouse distributes hardback books to retail stores. So Powell's Warehouse is a wholesaler. They buy the books from the publishers. Those are the manufacturers. And they take these books that they bought, they mark the price up and sell the books to Barnes & Noble, some retailer, and then Barnes & Noble sells the books to you, the end consumer. So we're Powell's Warehouse. We're a merchandising company. We're basically a retailer. We're just up a chain, right? Wholesaler. When we sell books to our customers, to our retail customers, we extend them credit terms 210 and 30. So we sell them books. They have to pay the full amount due. We sell on account. The fact that it says credit terms means we sell on account. We sell on credit. They don't have to pay cash. We sell on account. They have to pay the account off in full within 30 days. If they pay within 10 days, they get a 2% discount. During the month of June, these transactions occurred. These inventory transactions occurred. And what we need to do for each of these is make the journal entry. We use a perpetual inventory system, it says. All we need to do is make the journal entry. So let's do that. So the first transaction was on June 1st. We're Powell Warehouse. We purchased books on account from Catlin Publishers, publishing company. $1,040. Now their terms to us, in terms of us paying them back, we have to pay them back in full within 30 days. And if we pay within 10, we get a 2% discount. So our inventory goes up. How do we make inventory, which is an asset, go up? Debit or credit? Debit, yes. Thank you. Inventory go up. What else goes up? We didn't pay for the stuff, so what else goes up? A liability. In particular, accounts payable. And how do we make a liability go up? We credit it. That's the journal entry. Now I'm going to keep track with a little description. And you know what we usually do? Each of our account payable accounts that we have with our individual customers, we keep track of that in a separate T account. So we have an account payable-Catlin T account. And then if we buy from another customer on account, we maintain a separate T account for that customer, account payable-whoever. And then we have a master account payable T account that simply is the sum of all the balance in the individual account payable. Does that make sense? That's how this really works in the real. We don't just have one accounts payable, the master. We do have the master, but then we have these as subsidiaries, separate ones that we add up the balances. And that's necessary because, we need to keep track in a separate account for this customer versus a different customer. It makes it easier for our record keeping. So on June 3rd, we sold books on account to Garfunkel Bookstore for $1,200. Now our terms to them are up here. We extend credit terms of this to all of our customers. The cost to us of these books that we sold to them for $1,200, when we bought those books originally, it cost us $720. So we're the seller now in this. We're Powell. We're Powell in all these transactions. It's just sometimes we're the buyer, sometimes we're the seller. So we're getting practice on both sets. Buying journal entries, selling journal entries from the perspective of both one entity, but buyer and seller. So we're Powell. We use a perpetual system. When we sell inventory, always there's two journal entries. Not one journal entry, two. The first journal entry recognizes the sales revenue and a corresponding accounts receivable that we have with our customer. The second journal entry recognizes the fact that our inventory has gone and we have cost of goods sold expense. Does that make sense? Two journal entries. So we're going to increase our accounts receivable with Garfunkel. We're going to keep a separate account receivable T account for each of our various customers that we have an account receivable with. Just like with the accounts payable, same thing. So accounts receivable Garfunkel for the sales price of $1,200. We want to increase our sales revenue as well by crediting sales revenue. So assets go up. Not cash, we didn't get cash, but we got a promise that we're going to get cash in the future. That's an asset, that's called accounts receivable. Sales revenue goes up because we gave them the goods, the books, so we've earned revenue. Revenue goes up with the credit. All right, if we only did that journal entry, we're not quite done, right? Because we've just given them books that cost us $720. So our inventory should go down by $720, and our cost of goods sold expense should go up by $720. So we make that happen by debiting cost of goods sold expense for $720. That increases cost of goods sold. Expenses are increased with a debit. And then inventory, which is an asset, needs to go down by $720. How do we make an asset go down? Credit it. Notice two journal entries when we make a sale, and we're a perpetual company. We use perpetual inventory system. If we're a periodic inventory system company, only one journal entry when we make a sale, but don't worry about that. That's the appendix. We would make this entry. If we used a periodic system, we would not make this entry. We wouldn't update the inventory account perpetually because we're using a periodic system. We would update it at the very end of the month, but don't worry about that. All right. 6.6. I'm making a little note. Sold on account to Garfunkel. 6.6, we paid Catlin Publishers in full. So that June 1st account that we established with Catlin, we owed them. We pay the account in full. The only question is June 9th more than 10 days after June 1st? Because those were our terms. If we pay within 10 days from that date, we're paying on the 9th, then we get a 2% discount. So all you do is take the date we pay minus the date that we purchased. And if you get a number bigger than 10, no discount. If you get a number equal to 10 or less, or equal to whatever this number is or less, you get discount. So 9 minus 1 is 8. That's less than 10, discount. What's the latest we could pay and still get a discount? June 11th. June 12th, no discount, because 12 minus 1 is 11, which is bigger than 10. That's how that works. So we're paying our account off with Catlin. Here's the account payable we have with Catlin that we're paying off. But we don't have to pay that to satisfy that liability. We only have to pay 98% of that to satisfy that, right? So we're definitely going to debit that liability for the full amount because we're satisfying the full liability. We can get rid of it by debiting it. We no longer have a liability with Catlin. But to satisfy that liability, we do have to give up an asset, cash, but we only have to give up 98% of that because we get a 2% discount. So 0.98 times 1,040 is 1,019. What are they doing here? Do they allow us to just... Why are they not getting the same? No, they got it. Yep. So let's just round. No, I won't round. I'll keep it. I'll keep everything exact. You can round sometimes, but to like $1,019 instead of $1,019.20, whatever. But we'll keep it exact. So give up that much cash, and we get a 2% discount. So 0.02 times 1,040 is $20.80 discount. So we know we need another credit for 2080, but the question is, what account does it go to? Anybody remember? We went over this on Thursday. Think of this. At any moment in time, inventory, right? At any moment in time, if we make an inventory T account just related to the inventory from Catlin, the balance in the inventory account has to equal exactly what we've paid for that particular inventory at that moment in time. So originally put 1,040 in, right? And after paying for that inventory, how much have we actually paid for the physical inventory that's sitting on our shelves? 1,019.20. But the accounting T account says there's $1,040 of inventory, but we only paid 1,019.20. That's why we have to credit inventory T account for 2080 so that the balance in the account equals exactly what we've paid. After doing that, the balance will equal 1019.2, which is exactly what we ended up paying. So that is why you credit inventory for the discount. That's the journal entry when we pay for inventory that we purchased in the past on account and we pay within the discount period. You always debit the account payable, credit cash, and credit inventory for the discount. All right, there's the supporting calculations where how I got those numbers. And then the 15th. We received payment in full from Garfunkel. First question I want to ask is, did Garfunkel pay within our discount period? There are our terms we offer to our customers. We sold the books to them on the 3rd. They're paying off their account receivable. They have an account payable with us, but we have an account receivable with them. We're collecting the account receivable from them 12 days after we sold the books to them on account. So do they get a discount? No. So the journal entry from our perspective, debit cash. How much are we expecting to receive from Garfunkel? We have a $1,200 account receivable with them. So debit cash for $1,200. And get rid of all of their account receivable. So that's the journal entry on the 15th. 17th. I guess I didn't need to put these notes. We don't have to clutter this document up. We can remember who we're selling, to whom we're selling, and from whom we're buying. 17th. Sold books on account to Bell Tower, $1,200. The cost of the merchandise sold was $730. This is exactly the same type of transaction as what we did on the 3rd. So there's going to be 2 journal entries, follow the same procedures. So what I'm going to do then to make this faster is I'm just going to copy and paste this and then just change the appropriate things. When you sell on account, or even if you sell for cash, there's always 2 journal entries. We just have a different account receivable with a different person. And then was it $1,200 again? Yeah, it was $1,200, so this is the same. And the person was, or the Bell Tower was the name. And then the cost of the merchandise sold to them when we originally bought it, $730. So there are the 2 journal entries on the 17th. Now, you obviously on the exam, you don't have to you won't be given a question like this and say, what are all the journal entries? But if you understand how we do this problem, you'll get questions on the exam right, because I'll just pick out one of these, like this one. And then I'll give you some question. I'll say, there'll be 4 journal entries in the potential answer, and I'll say, which of these journal entries is one of the journal entries that would have been done? And like that'll be one of the 4 choices, and the other 3 choices won't be any of those. Does that make sense? So understanding this, you can get in other words, I can embed in a multiple choice format on the exam testing your understanding of these concepts. So it's okay. It's not a waste of time to do it this way. This is actually the best way to do it, is literally do the journal entries. Then the exam questions should be pretty straightforward. 20th. Definitely use your scratch paper on the exam. If I saw a question like that I just described on the exam, I would first myself make the journal entries that should be made on my sheet, and then look at the question and say, well, which one of these matches? That's how I would do it. I wouldn't look at the 4 choices and then in my mind try to think, that's not the way to do it. You do them yourself and then try to find the right answer in the choices. That's the way to do it. Unless you don't know what's going on, then you guess. But the 20th, we're back to purchasing books on account again. So this is the 20th transaction is going to be just like the first transaction. We just have a different company from whom we're purchasing, and the terms are different. They give us 15 days to pay. So I'm going to take this transaction we did on the first and just copy and paste it and then just change the appropriate things. So we're buying $800 of inventory, and the publisher from whom we are buying is Priceless Books. and it was 800. All right. Then on the 24th, we received payment from Bell Tower. So Bell Tower, we sold to them on the 17th. We have an account receivable with them for $1,200 currently. As of the 24th, we still have that account receivable with them. 24 minus 17 is 7. We give 10 days. If they pay within 10, 2% discount. So they're going to get a discount. And we're getting payment from them. So they're paying within the discount period. And so this journal entry is going to be just very similar to what we did back here on the 6th when we got paid by Catlin and they paid within the discount period. So just copy and paste. But now it's Bell Tower, not Catlin, that we're receiving money from. Now the account receivable we had with them was $1,200. Wait, did I say something wrong? No, this journal entry, yes, I did say something wrong. That was when we paid within the discount period money that we owed someone else. This is going to be similar to the entry on 6/15 where we received money from Garfunkel who owed us $1,200. The only difference is, in this case, the Bell Tower is the person who owes us, and they're paying within the discount period, whereas Garfunkel, when they paid, they paid outside of the discount period, so they didn't get a discount. So it's going to be similar to that entry, but not the same. So we're definitely going to debit cash for the $1,200. That's what Bell Tower owes us. But Bell Tower does not have to pay us $1,200. We're going to debit cash for what we end up receiving from them, which won't be $1,200. We're going to credit accounts receivable for $1,200 because they're satisfying the complete account. But they're not paying us $1,200 to satisfy the $1,200. They're only paying 98% of $1,200. So this number that goes here is just 1,200 times whatever, 0.98. That's how much we're getting from Bell Tower. $1,176. And the other $24, which is computed as the 1,200 times 2%, is the discount. We need another debit, obviously, in the journal entry to make sure debits equal credits. The only question is, what account do we debit? You would think you would debit sales revenue, right? To kind of reduce sales revenue. Because earlier, when we sold the stuff to them on account, we credited sales revenue for $1,200. But we don't end up collecting $1,200 from them. We only collect $1,176. So we should reduce revenue by 24. And we do reduce revenue by 24, but we don't do it by debiting sales revenue, even though that would reduce revenue by 24. We do it by debiting sales revenue's contra account, sales discounts. So when you're the seller and the person pays you back within the discount period, you're always going to debit cash, credit the account receivable, debit sales discounts for the discount. So the net sales revenue from this sale is what? It's the gross sales revenue minus the balance in sales discounts, which is exactly the cash we received from them. Does that make sense? Sales revenue has two contra accounts, sales returns and allowances and sales discounts. And the balances in both of those accounts reduce the balance in sales revenue. The net sales revenue is gross sales revenue minus sales returns and allowances minus sales discounts. That's that one. And then the 26th, we pay off our account with priceless books. Are we paying within their discount period? Their discount period is 15. So yes, we are, but we're only going to get a 1% discount. That's what their terms were. So originally, the 20th, so we're paying off the $800 account, but we only have to pay 99% of $800. So we're going to reduce the account that we have with them in full. We get to reduce the full liability, and we're going to credit cash for 99% of $800. We only have to pay $792 to reduce an $800 liability because we paid within the discount period. And then we're going to credit inventory for the discount of $8. This number is just the $800 times 0.98. And this number is the $800 times 0.01. This should be 0.99. You guys get the idea. The general form of the journal entry when we pay off an account within the discount period, you're debiting accounts payable, crediting cash, crediting inventory. When someone is paying you back for stuff they owe you and they pay within the discount period, there's the general form. You're debiting cash, you're crediting accounts receivable, and you're debiting sales discounts. Now the numbers change based on the problem, but that's the form of the journal entry. You should know those things. If we pay them back but not within the discount period, then we would debit account payable, just credit cash. There's no discount, so there's no credit to inventory. If Bell Tower would have paid us back but not within the discount period, we would just debit cash, credit accounts receivable. There's no need for another debit. There's no discount. All right. 28th, we make another sale to another publisher on account, $1,300. The cost of the merchandise sold was $780. So 2 journal entries need to be made when we make a sale on account originally. So this is going to look very similar to this journal entry we did here. So I'm going to copy and paste this. So the person we have an account receivable with now is a General Bookstore. And the amount is $1,300 and the cost is $780. So it's $1,300, $780. That's the 2 journal entries we make on the 28th. And then the 30th, and then the end of June comes at the 30th. We granted General Bookstore $130 of credit for books that they returned to us. And the books that they returned to us that we're granting them $130 credit, we originally, when we bought those books, before we sold them to them, it cost us $80. So when someone who we've sold to on account returns stuff to us that they still owe us for, right? They haven't paid off the account, but they return some stuff to us and we give them a credit. we have to undo a portion of this journal entry, and we have to undo a portion of this journal entry. We have to make two journal entries. So the first one undoes this. So $130 worth of an account receivable that we have with them, we no longer have with them. That's what giving them a credit means. It means, yeah, you gave us the stuff back, you don't owe us that $130 anymore. They don't have that account payable of $130 anymore, and we don't have the account receivable. So we got a credit account receivable for $130. To show that that asset goes down. And we need to reduce sales revenue by 130 because we originally recognized sales revenue, but now they give the stuff back to us. We don't have the revenue then, right? But you don't debit sales revenue, you debit the contra account to sales revenue. Sales returns and allowances, the other contra account. Debiting this contra account to sales revenue has the effect of reducing net sales revenue. Because net sales revenue is the balance in sales revenue minus the balance in sales returns and allowances, minus the balance in sales discounts. So debiting sales returns and allowances makes sales returns and allowances balance go up, which makes net sales revenue go down. So that undoes $130 of this journal entry. And then we need to undo $80 of this journal entry because the stuff that they returned to us originally when we sold it to them, it cost us $80. So 80 of this was originally, that we sold was returned. So we just need to flip this. We need to debit inventory. We've got $80 of inventory coming back in, and we need to reduce cost of goods sold expense by crediting it for 80. I'm just going to put COGS. When I say COGS, I mean cost of goods sold expense. And those are all the journal entries for all of these transactions in June. Let's make a little income statement for this month, just related to these transactions. Even though it doesn't ask us to do that. We're going to have our sales revenue section, and now we need to have a separate section called sales because we do have sales returns and allowances and sales discounts. So we would list sales revenue. What's the total sales revenue? If we were to make a T account for sales revenue and put all the stuff into it, there's sales revenue of $1,200. Here's sales revenue $1,200. Here's sales revenue of $1,300. So 1,200 plus 1,200 plus 1,300. 3,700 is our sales revenue for the month of June. But that's the gross sales revenue. What's the balance at the end of June in sales returns and allowances? And what's the balance in sales discounts? The balances in those two accounts have to be subtracted from gross sales revenue. So the balance in sales returns and allowances, just go through the journal entries, find sales returns and allowances. Well, we just have that one at the end of the month. 130 should be the balance. So if we write the word less here, then we don't have to put parentheses around this to show it's subtracted because we wrote the word less. If we don't write the word less, then we do need to put parentheses. And then sales discounts, less means we're subtracting. Balance in sales discounts, all those debits we made to sales discounts. We made at least one. On the 24th, we debited sales discounts for 24. I guess that was the only one, wasn't it? And so net sales revenue Net sales revenue would show up as a line item on a multi-step income statement. It would not show up as a line item on a single-step income statement. Single-step income statement would just have net sales revenue. Well, maybe I should have rephrased that. Don't worry about that. Single-step income statement is not allowed by GAAP anyway. All that really matters is a multi-step. That's what you need to know. Net sales revenue is 3,700 minus 130 minus 54, 3516. Now, from net sales revenue, time to subtract cost of goods sold expense and total COGS. What would the balance in COGS be? We put 720 on the 3rd. We put 730 on the 17th. We put 780 on the 28th. And then on the 30th, we took out 80. So 720 plus 730 plus 780 minus 80. You should have a balance of 2150 at the end of the month. So sales minus COGS is, or we don't need to put, everybody knows it's a subtraction. You don't have to put that. $1,366. That would be our gross profit. And then from that, we would subtract all of our other operating expenses to get our operating income. And then from our operating income, our net income from operations, we would add any other revenues or gains, subtract any other expenses or losses that are non-operating to get net income, which in this problem, there aren't anything else. That is the net income, right? Does that make sense? But there's a little income statement. The gross profit is the net income in this problem. There are no other expenses other than COGS. And there's no other revenues other than sales revenue. But all right. That finishes those two things. I think that helps you with a lot of concepts in Chapter 5.